Banks have an important role for the economy and are needed by the public in their day-to-day transactions. This is even more so the case in the Asia-Pacific region, where banks hold a significant share of financial assets. Data from the World Bank Global Financial Development Database show that this is as much as 126% of GDP, underscoring the significant role banks play in sustaining economic activity in the region. The role of banks, though, goes beyond just a number. It is more expansive when we consider the cross-ownerships and partnerships that banks maintain with other components of the financial market. As much as banks have been a partner, challenges do arise from time to time from our reliance on banks. Crisis after crisis, we are reminded of Greenspan's caution that the financial market needs a spare tire when banking difficulties arise. This spare tire comes in the form of the non-bank financial sector. Through the non-bank sector, savers can become investors, dealing directly with corporate issuers or taking advantage of contingent assets and investment funds. This seems like a lot of money, and generally the answer is yes. But we probably may not remember that ASEAN saves at a higher rate than the rest of the world. This is an important point to our collective financial market journey. Taken together, ASEAN would be the fifth largest economy in the world, with prospects anchored on economic growth and cultural diversity. The irony is that only a very small portion of ASEAN savings is retained in ASEAN. This literally tells us that it is offshore markets that benefit more from the funding liquidity that ASEAN could have used onshore. In 2023, $3.84 trillion in portfolio investment flowed outside the ASEAN, a number that likely understates the true picture because we only account for end-of-period data rather than the actual dynamism of in and out funding. It is then not surprising that the authorities seek a more balanced financial market, one that continues to benefit from banks just as we tap the opportunities from the non-bank financial sector. Yet this desire for a more balanced financial market is not new. We are witness to various roadmaps and plans, all intending to create a spark in the capital markets. Already there are good narratives from ASEAN. We have seen the non-bank financial sector slowly grow. But when we compare ourselves to Europe or North America, we know that there is still a long path ahead. With so much more onshore potential untapped, there is strong belief that the aspirational goal of an active non-bank financial sector is achievable. What constraints do we face in developing the non-bank financial sector? This is the question that we have often heard. By now, the answers are perhaps well known. Experts point to information accessibility, market liquidity, risk pricing, support for critical products, and resilient infrastructure as among the key elements. Knowing what we know, perhaps the more telling question to ask is, why have we not made significant strides in the non-bank sector if we have identified its missing elements? What balance should Asia strike between the banking and non-bank sector? What risks present themselves in moving from the status quo and into a more developed non-bank sector? While technological innovations help bring down barriers and transform options into opportunities, is Asia ready to take the leap forward? These are the important issues that will shape the region as we move forward. Listen to what the experts have to say and be part of our Systemic Risk Dialogue. Join us in Mactan this November. Your peers will be there too.